Welcome. Today I would like to explain the different types of business structures that are available, and with a particular reference to internet marketers. The information in this video applies to Australia only and is only intended for general information purposes, and you should obtain expert advice in relation to your specific circumstances. It is important to note a couple of things at the start. 1. The right business structure will be different for each person depending on their future goals, assets, type of business, family and income levels. 2. It is important to have the right structure in place as soon as possible to get the maximum protection in case of bankruptcy. In general terms, we look at the business structure in terms of tax, asset protection and the type of business. With tax, we want the business structure to be able to be flexible enough to take best advantage of the tax laws. Ideally, we want to be able to distribute income to take advantage of the lowest marginal tax rates. This can include directing income to your spouses and children, although the ability to distribute income to your children is now less beneficial due to a change in the tax laws. A quick thing to remember is that the tax laws are always changing with both case law and legislation, so it's important to review your structure at least yearly to ensure that it is always appropriate for your current and expected future circumstances. The other area of tax that we take into account is capital gains tax. There are a variety of concessions available in respect of capital gains tax, including small business tax concessions and 50% discounts on capital gains. Capital gains tax applies when you sell an asset, but in terms of planning for business structures, we're looking at events that might happen into the future and are putting in place structures now that would enable you to save capital gains tax in the future. Asset protection. We want to protect your assets from claims by creditors and lawsuits by keeping your business activities separate from your other assets like your home. In terms of lawsuits, most would think that a small affiliate business has no risk because they are so small. But imagine that you're promoting a weight loss product as an affiliate. In that promotion, you send emails to your list and write reviews on your website. Later it is found that the weight loss product causes kidney damage and a class action is commenced, not only against the owners of the product, but also all the affiliates that promoted the product. Another possible case is where you conduct search engine optimization for a new client. Your SEO strategies are successful and your new client starts to earn significant revenue on the back of Google search traffic. However, a new Google algorithm views your strategies as black hat and penalizes your client. The search traffic disappears and your client makes significant losses. They sue in the Supreme Court. Even if they are not successful, your legal costs could easily exceed $100,000 before you even go to court. So let's start to look at the various business structures. Sole trader. A sole trader is the most simple business structure consisting of an individual trading on their own or operating under their own name or with a registered business name. The sole trader controls and manages the business and is responsible for all its debts and liabilities. The main advantage of being a sole trader is easily understood and inexpensive to run. Most internet marketers start businesses in their own name. They're just testing the ideas out and the investment is usually pretty small. Domains, Google AdWords, a few online courses. The business at this stage is no more than a hobby and the thought of business structure and the risks of doing business is usually not considered. They continue to develop their sites, adding more business models to the mix, all the while continuing to trade as a sole trader. The primary disadvantage of operating as a sole trader is that there is unlimited liability and your personal assets are at risk from your business activities. The other disadvantage is that there are limited opportunities to split income. Whilst it is cheap to operate as a sole trader, it does have some significant risks. Partnership. A partnership is formed when two or more people go into business together with the view of making a profit. They may operate under their own names or with a registered business name. A partnership is not a separate legal entity, and liability is unlimited and is extended to debts incurred by a partner without the consent or knowledge of the other partner. For this reason alone, we would never recommend that people go into business as a partnership. We would recommend either a trust or a company, depending on the nature of their business. The only situation where we have clients operating as a partnership is husband and wife owning a negatively geared investment property. As a quick side note, if you're going to go into business with someone, including and especially relatives, you must get the following before you start doing business: advice in respect of an appropriate structure, and a shareholders agreement and management agreement that sets out what happens in situations of dispute, such as if one person wants to leave, if more money is required to be injected into the business, and how each person is to be paid for what work. A shareholders agreement would prevent most of the litigation between shareholders in small businesses that I see. Before you start, it is the best time to talk with your partners about what happens if everything goes badly. A proprietary limited company is a separate legal entity able to do business in its own right. Companies are designed for business. The shareholders own the company, and the directors run the company on the behalf of shareholders. The company's operations are subject to the corporations law and overseen by ASIC. You can have single director, single shareholder companies. There are costs associated with operating a company, with the costs of establishment of a company at around $500 and annual filing fees of around $212 per year. In addition, you're going to have extra accounting fees. The company offers a greater level of protection as opposed to some of the other business structures like a sole trader and partnership, as the business activities and liabilities are separated from your personal assets. Companies are subject to complex corporations law, case law and tax law. The protection offered by companies can be defeated. Major creditors will often require directors to personally guarantee the company's liabilities. Also, trading whilst insolvent will expose directors to the company liabilities. But companies are often the best structure to operate a business, and especially where new business owners and equity is to be introduced into the business. The advantages of the companies are a single flat tax of 30%, which is less than the top marginal rates. You can access the CGT small business concessions. It's got dividend imputation, and when the tax paid by your company can be passed on to the shareholders through dividend payments. Companies can access FBT salary packaging like motor vehicle benefits, and profits can be retained in the company. This is particularly important with companies that have working capital requirements associated with growth. The disadvantage of companies are the losses can get trapped in the structure. There's some complex rules. Trusts. Whilst there are a number of different types of trusts, I just want to focus on discretionary trusts or family trusts. Trusts are a strange beast and very useful in terms of tax flexibility and asset protection. A trust is not a separate legal entity. A trust is managed by the trustee for the benefit of the beneficiaries. The assets of the trust are not owned by the trustee but held on behalf of the beneficiaries. We would always recommend that a trustee is a company for asset protection purposes. Now, the beneficiaries are defined by the trust deed and will generally include your spouse, your children, your grandchildren. It may also include your parents, siblings, and also companies. The tax benefits of this are that you can stream income from your business to other members of your family to take advantage of different marginal tax rates. But beware, the rules associated with trusts can be complex. Often we will recommend to our clients a corporate structure that is a combination of companies and trusts. For example, the trading entity being a company with the sole shareholder being a discretionary trust with a corporate trustee. This enables the business to operate as through a company and the dividends to be streamed through the family, whilst the individual has no ownership of that company. The structure that we develop for your business will be different for each person. We'll take into account a number of different factors, such as the nature of your business, your future business plans, your family structure and personal assets, the cash flow requirements of your business, your overall tax strategy, your succession plans and exit strategy, and of course the complexity and cost of the structure. In summary, we look at separating your personal assets from your business liabilities. It is important to get the right structure in place as soon as possible, especially if you are trading as a sole trader or partnership. It is also important to be regularly reviewing your business structure to ensure that it is best for your current and future goals and assets. And finally, get expert advice. The investment will be well worth it. The correct business structure could save you thousands of dollars of tax easily a year. If you have any questions, you can contact me at ashields@dolmanbateman.com.au.